But beneath the surface of this green canvas, a complex story unfolds. We've seen headlines hinting at the highest inflation rates in US history, a stark reminder of the persistent challenge central banks face. Yet, juxtaposed against this, are reports from the Florida Chamber of Commerce indicating job losses in some regions, painting a mixed picture for the labor market. It's a market grappling with contradictions, where every uplift is met with a question, and every dip holds a lesson. We'll peel back these layers today, exploring the why behind the numbers you see scrolling below, and more importantly, the what next for your portfolios. The global stage at Davos has, as always, become a crucible for the minds shaping our economic future, and their words are reverberating through the markets. We heard from former President Trump, making his presence felt with the launch of his Board of Peace, a move that, regardless of its immediate impact, injects a layer of geopolitical intrigue into an already complex global landscape. His pronouncements on economic growth and even hints at his preferred candidate for the Federal Reserve chair add to the political uncertainty that markets simply loathe, or love to trade on. On the corporate front, the titans are speaking. NVIDIA's CEO, Jensen Huang, is confidently asserting that AI, the very engine of his company's meteoric rise, will not be the job killer many fear, but rather a catalyst for new opportunities. This optimistic outlook undoubtedly underpins the continued strength we're seeing in the AI-driven tech sector. Countering this, the Big Short investor Michael Burry sounds an alarm, seeing an AI bubble too big to save, a crucial contrarian perspective that reminds us to always consider the potential for exuberance. Then there's Cathie Wood, an ardent believer in disruptive innovation, making bold predictions for both Bitcoin and Nvidia. Her conviction often galvanizes a segment of the market, reinforcing the narrative around these high-growth assets. Michael Saylor, the architect of MicroStrategy's Bitcoin strategy, continues his evangelism, declaring that Bitcoin is the ultimate store of economic energy. This philosophical stance resonates deeply with a growing segment of investors seeking alternatives in a world of depreciating fiat currencies. His company, MicroStrategy, continues its impressive march, despite an analyst cutting its rating, strangely, amid discussions of Trump's renewed Greenland ambitions, a testament to how some market movements defy conventional logic and instead hinge on a single, powerful narrative. Meanwhile, OpenAI's Sam Altman is reportedly meeting with Mideast investors to secure a colossal $50 billion funding round, showcasing the insatiable appetite for AI investment and the global hunt for capital. And Jamie Dimon, a stalwart of Wall Street, has voiced rare criticism of Trump's immigration policy, a signal that top corporate leaders are becoming increasingly willing to weigh in on contentious political issues, indicating a broader discomfort simmering beneath the surface of economic discourse. Finally, Ray Dalio, the legendary hedge fund manager, sees an ongoing diversification away from U.S. assets, a long-term trend with profound geopolitical and financial implications, suggesting a potential shift in global economic gravity. These voices, diverse and powerful, paint a rich tapestry of the forces shaping our financial future. Let's turn our attention to the often overlooked, yet profoundly influential, bond market. Today, we're seeing U.S. Treasury yields pull back somewhat. This move is significant because bond yields are a critical indicator of market sentiment regarding economic growth and inflation. When yields fall, it can suggest that investors are either seeking the safety of government bonds, perhaps anticipating a slowdown in economic activity, or that they are beginning to price in the expectation of future interest rate cuts from the Federal Reserve. However, this dynamic is particularly intriguing today given the recent Reuters poll suggesting the Fed is expected to hold rates steady through March, and potentially even throughout Chair Powell's entire tenure. This creates a fascinating divergence. The bond market, through falling yields, might be signaling a more dovish outlook than the Fed's public stance. This tension between market expectations and central bank rhetoric is a constant dance, and the bond market often provides the first subtle cues about where that dance might lead. A persistent decline in yields could, for instance, make borrowing cheaper for corporations and individuals, potentially stimulating certain parts of the economy. But it also reflects lower growth expectations, which can weigh on risk assets over the long term. The central banks remain firmly in the spotlight, their every word and action dissected for clues about the future trajectory of global economies. The Federal Reserve, as we just discussed, appears to be holding the line, with reports indicating a strong likelihood of maintaining current interest rates through at least March, and possibly beyond, during Chair Powell's remaining term. This stance is a delicate balancing act, designed to cool inflation without tipping the economy into recession. It's a commitment to stability, but one that challenges the more aggressive rate cut expectations that parts of the market have been clinging to. Across the Atlantic, the European Central Bank is also navigating its own intricate path. The news of Vučić winning the race for the ECB's number 2 job is a win for Eastern Europe and could signal subtle shifts in the bank's internal dynamics and future policy leanings. We also caught a glimpse of the tensions in Europe when ECB President Christine Lagarde reportedly made an abrupt exit from a Davos dinner after critical comments about the continent's economic state. Such incidents, though seemingly minor, underscore the deep anxieties surrounding Europe's economic health and the pressures on its central bank. Meanwhile, the UK presents its own inflation challenge, with consumer prices rising for the first time in 5 months. This climb to 3.4% in December complicates the Bank of England's picture, potentially delaying any thoughts of easing monetary policy and keeping the pressure on British households. These central bank developments, from the Fed's steady hand to Europe's internal struggles and the UK's renewed inflation concerns, are critical pieces of the global economic puzzle, each with the power to influence currency valuations, bond yields, and ultimately, the earnings potential of multinational corporations. Today, the commodities market is painting a vivid picture of global economic and geopolitical pressures, with some truly eye-watering moves. Let's start with gold, the ancient store of value, which has truly shone brightly. We've seen gold prices hit an incredible new record, soaring well over $4,800. This milestone is not just a number. It's a powerful statement from investors seeking refuge and a hedge against the persistent uncertainties of inflation, geopolitical tensions, and potentially a weakening dollar. While the immediate 24-hour snapshot shows a slight consolidation after that historic surge, the narrative of gold as a safe haven and a bulwark against instability remains profoundly strong. Now, to the energy complex, where the story is decidedly mixed. Crude oil, both West Texas Intermediate and Brent benchmarks, is seeing a pullback. This softening comes on the heels of the International Energy Agency's report forecasting a significant market surplus in the first quarter. The IEA's assessment points to ample supply, potentially easing some of the inflationary pressures from energy costs. However, the world oil market remains susceptible to geopolitical shocks, and any disruption could quickly flip this surplus narrative on its head. But the real showstopper today in energy is natural gas. Prices have absolutely skyrocketed, soaring an astounding 60% in just 2 days. This dramatic surge is directly tied to the gripping cold wave sweeping across the United States. What does this mean for you? It means higher heating bills, increased costs for industries reliant on natural gas, and a stark reminder of how vulnerable our energy infrastructure can be to extreme weather. This isn't just a pricing anomaly. It's a critical supply-demand shock that has immediate and tangible consequences for economies and households. The interplay between these major commodities, gold's flight to safety, oil's supply surplus, and natural gas's weather-induced spike, paints a complex and often volatile landscape for investors to navigate. Today's sector performance is a study in contrasts, revealing where investor confidence is truly flowing. Overall, the broader market indices, from the S&P 500 to the Nasdaq 100 and particularly the Russell 2000, are all showing healthy gains. The stronger performance from small caps is often an encouraging sign, indicating that investors are willing to take on more risk and see broader economic growth ahead. Within the technology sector, it's a fascinating split. Companies at the forefront of the AI revolution, like Nvidia and Tesla, are experiencing robust rallies, buoyed by innovation narratives and strong forward-looking sentiment. Google and Meta also demonstrated solid upward momentum, reflecting continued strength in digital advertising and evolving AI strategies. However, it wasn't a universal tech party. Apple saw more modest gains, while Microsoft, surprisingly, experienced a notable decline. This could be indicative of profit-taking after strong runs, or perhaps a rotation within the mega-cap tech space as investors refine their bets on specific growth drivers. Energy stocks, as represented by the XLE ETF, are also seeing a significant uplift today, which at first glance might seem counterintuitive given the slight dip in crude oil prices. However, this strength in the broader energy sector is almost certainly being driven by the colossal surge in natural gas prices we just discussed. Companies involved in natural gas production and distribution are likely seeing a revaluation, pulling the entire sector higher. Furthermore, financials are showing modest gains, which could be attributed to a more stable outlook on interest rates and a resilient, albeit complex, economic picture. It's a market actively re-evaluating, constantly shifting capital to where it perceives the most compelling growth or value stories lie. The crypto market continues its fascinating journey, steadily building its narrative as a legitimate asset class, and today offers some compelling insights. Bitcoin, the undisputed king of digital assets, is showing modest but consistent upward movement, quietly approaching a significant psychological milestone. This resilience is a testament to its growing acceptance and its role as what Michael Saylor eloquently calls the ultimate store of economic energy. As traditional currencies grapple with inflationary pressures and global uncertainties, Bitcoin offers an uncorrelated alternative for many investors. Ethereum, the powerhouse behind countless decentralized applications, is also moving in tandem, demonstrating the overall positive sentiment within the digital asset ecosystem. Its continued development in areas like DeFi and NFTs solidifies its position as a foundational layer for Web3. But perhaps the most intriguing story linking the traditional markets to the crypto world today is MicroStrategy. Despite an analyst cutting its rating, and for a rather unusual reason tied to geopolitics, the company's stock continues its impressive climb. This phenomenon underscores a crucial point. MicroStrategy has become, for many, a direct proxy for Bitcoin exposure in the equity markets. Its stock performance is less about its core business operations and more about the market's bullishness on Bitcoin itself. This symbiotic relationship highlights the increasing institutional comfort with crypto, even if accessed through a corporate wrapper. The sustained interest in MicroStrategy signifies a deeper, more structural belief in Bitcoin's long-term value proposition, making this crypto corner a vital area for any discerning investor to watch. As we look towards the next trading session, the signals we've analyzed today set a complex but intriguing stage. The underlying strength we're seeing in broader indices, particularly small caps, suggests a persistent undercurrent of optimism. However, this optimism is continually challenged by lingering inflation concerns, which, despite the Fed's steady hand, remain a historical backdrop for monetary policy decisions. We'll be watching closely for any further insights from global leaders and central bankers. The ongoing discussions at Davos, including any unexpected appearances or pronouncements, could easily shift market sentiment. Pay particular attention to comments from central bank officials, whether from the Federal Reserve, the ECB, or the Bank of England, as any deviation from current expectations on interest rates could trigger significant market reactions. Commodity markets will also be a key focus. The trajectory of natural gas prices, heavily influenced by weather patterns, will continue to impact energy costs and inflationary expectations. Gold's ability to sustain its new record highs will signal continued safe haven demand. And the delicate balance between crude oil supply and demand, as highlighted by the IEA, will dictate energy sector performance. Finally, keep an eye on the tech sector, especially the nuanced performance within mega caps like Microsoft, and the continued momentum of AI leaders like Nvidia. The narrative around AI's impact on jobs and economic growth, debated by figures like Huang and Burry, will shape investor confidence. So, what's the ultimate takeaway from today's whirlwind of financial activity? It's a market defined by fascinating contradictions and powerful narratives. We're witnessing a tug of war. On one side, a robust belief in growth and technological innovation, especially in the AI space, driving major tech players and signaling a risk-on appetite in small caps. On the other, the persistent shadow of inflation, geopolitical intrigue, and the very real impact of commodity shocks, particularly the astounding surge in natural gas prices, that remind us of the fragility and interconnectedness of our global economy.